Welcome back. Well, Titan is really the stock on our radar. The company saw earnings that were a miss. EBITDA, margins, profits came in below street estimates. The top line was actually not bad. It was a 16% growth that the company saw on the top line. But it's really the performance on the operational front, perhaps because of competitive intensity, which the company did speak about. They said it is increasing. They expect it to continue. So that has hit the margins. In fact, EBITDA growth has been in low single digits. About 6.5% growth is what the company has seen. And even in terms of their jewelry business, which is their mainstay, the margins over there fell to about 10.8% versus 11.6% same time last year. So clearly they are struggling on that front. The stock, if we just pull up the stock for you, it has been under a bit of pressure this morning, down, okay, now actually worsened, so down almost about 5% odd. We have Ashok Sonthalia, the CFO of Titan, joining us now to talk about that. Mr. Sonthalia, good morning and thanks a lot for joining in. I know you did mention that the competitive intensity is going up, but can you quantify it for us a little more? In the jewelry business, your margins have fallen a bit to about 10.8% this quarter. Do you think it could get worse before it gets better? And what is the kind of trajectory you're hoping to see in margins for the jewelry business?
So thank you, Sonia, and good morning to all of you. It has been a good quarter from the growth point of view and a good year from growth point of view, whether it was jewelry business or all other segments their company operates in. So at a consolidated level, actually, we grew by 22% in this financial year, which just we ended. As far as jewelry margin is concerned, yes, two factors: gold price volatility and actually spiking a lot during the year, almost 18 to 20% as of now, gold prices have gone up. And the competitive intensity that we talked about, the existing jewelers are expanding aggressively. Many new players are coming in, and a lot of retail capacity has got created. And I'm sure demand, because of the gold price volatility also, is slightly slower to catch up. And whenever gold prices are volatile, consumer sentiment do get a bit beating till it stabilizes. So both these factors, I think, contributed. We wanted to prioritize our market gain share, the acquisition of new customers, over margin, and a lot of consumer offers and gold exchange programs were there during the quarter, which took some beating on the margin. But one point, certainly, I would like to tell you, when we have talked about FY23 margin profile, we always said that there was some of the one-off gains which contributed close to 1%. So if you normalize for that, 30-40 basis point further pressure, which FY24 and Q4 has seen in jewelry segment.
Okay. It's interesting, Mr. Sonthalia, you say that the existing players, as well as there are some new entrants in the market that are perhaps creating this competitive intensity. So far, Titan has, of course, been one of the largest players in the organized market across your segments. So what is it that these new players are doing that is sort of threatening either your market share or your margins? Is it on the pricing front? And what do you think you can do better to kind of combat this competition?
So in Q4, we got 54% share from the new buyers coming to us, which used to be, if you recall, 48%, 49%, 46%. So certainly we have gained new customers coming into Titan, Tanishq, and other brands. Our assessment says that in many catchment, many regions, we have actually slightly gained market share. The one segment where competitive intensity has really gone up because of the new startup, new players is the sub 1 lakh category, which is a daily wear category, and it's a strong contributor to overall top line and margin. And there we see a lot of competition coming in. Even in the high price points, the existing large players also are expanding a lot. The regional players are expanding a lot. So all of a sudden, jewelry industry is seeing a lot of action by all the players in terms of the retail network expansion, etc. And you need to play tactfully, responding to them so that in the short term, you not only maintain your market share, but still continue to gain new customers.
Mr. Sonthalia, hi, good morning. Prashant here. I remember last time we spoke, and my question, we've discussed this quite a few times, right? The impact of artificial diamonds. You'd said that on the high, the high value you'd seen some slowdown. This was back in Feb. You said high-value solitaires, you've taken some price cuts also. And lower-priced diamonds, there are also some slowdown. Could you tell us what you saw in the quarter gone by?
So, addressing this artificial or lab-grown diamond phenomena, we have been keeping a close watch. If you look at globally, in US bridal engagement ring segment, lab-grown diamond have made a meaningful entry and substitution to natural diamond. But if you look at other geographies like China or Europe, I think these diamonds still have not kind of got much traction. As far as India is concerned, yes, some of the new players have entered into, some of the new brands have started getting into this segment. And the large caratage diamond, where the price advantage comes meaningfully, which includes solitaire, and that continued to be so. There we saw some slowdown in our growth. But as far as the small diamonds are concerned, they are okay. In India, still we don't see too much traction of lab-grown diamond getting in these segments. We are keeping a very, very close. This is an important development which is happening. But as I told you, globally, different kind of acceptance is coming in, and we are keeping a close watch on this.
Would some of these smaller, newer entrants on the smaller diamond side, if they make an aggressive entry, I mean, how would you then sort of deal with it? Because that would be the natural place where they'd go, right? Where they'd start.
Yes, so they are also able to attract, as I told you, the larger caratage, which is say 70 cents or 1 carat and above, where the price advantage is there, and some of the consumers are becoming inquisitive or adding to their jewelry portfolio some of these jewelry items. As I told you, Prashant, we are keeping a very, very close watch on this. And we will be making our moves if consumer really finds this category very attractive.
All right. Hi, Mr. Sonthalia, and good morning and good to see you in. Nigel on this side. I want to ask you on two parts. One is on the market share. I think the aspiration was to get to around 10%. By when do you get to that? And on the margins, the jewelry margin guidance you have given of around 12 to around 13%. As these prices of gold, competition is going to remain elevated. So what's giving you that confidence that you can hold on to this band of 12 to 13%? Market share and margins. Please go ahead.
So 10%, our expectation was by FY27, we should be around 10%, double-digit market share. And I believe we are on track of that. Of course, the jewelry industry growth is something which is unknown. But if you look at the long term, the way industry has behaved, by FY27, we should be at 10% market share. And we kind of still confident about that. As far as margin is concerned, I do expect that this competitive intensity would stay for 12 to 18 months for sure before some of the weaker players or some of the other players from where we are gaining the market share either exit or become further weak. 12 to 13%, I believe going forward, margin is going to gravitate more towards 12%. So the center of gravity is about 12% for next 1 to 2 years before market really competition stabilizes. And but we do take many actions, and which are internal to us to maintain our margin profile. We have always said growth is priority, but not at the cost of margin. We'll try to maintain 12% plus minus range, the jewelry business. Yeah.
Okay. Mr. Sonthalia, I want to come back to that point you made. And it's very interesting for me because it's not just for your own industry, right? But it seems like the dynamics for the consumer space overall are changing. You said that the below 1 lakh market is seeing increasing competition from startups. Now, these startups are, of course, it's a very nascent stage compared to a formidable player like yours. So what are they doing right? How are they targeting that below 1 lakh customers? Is it largely a change in marketing spends? Is it more digital versus, brick and mortar? And I want to understand, what is your takeaway from that? Will you go ahead and sort of raise your marketing spends more in the digital space? Will you cut down on your, offline stores? Just if you can help us with a little understanding of how the next 1 year could look like.
So, Sonia, we have very, very strong brands like Carrot Lane and Mia playing in that segment, and they are growing very well. So I would say they are still dominating that segment. And within Tanishq also, there is a sub 1 lakh, which we generally call daily wear category, is doing very well, and we kind of continue to focus. So with the combination of three brands, Mia, Carrot Lane, and Tanishq daily wear offering, I think we are playing very, very strongly in that segment, because customer acquisition and recruitment happen through that segment most of the time, and then they kind of progress the value chain. Yes, the marketing spends have largely moved already. We have large marketing spend in our jewelry business, but quite a significant part has already moved to digital medium. But the question is from performance marketing versus brand building. We focus quite a bit on brand building. Carrot Lane, which used to focus a lot on performance marketing, have started moving towards brand building. The startup and new players generally focus more on performance marketing, digital spend, which is becoming very, very expensive. So if you really want to sustain this game, your brands have to be pulling the customer, brands have to be connecting with the customers. And I think that is what we are doing.
In terms of number of stores, how many stores do you plan to add for Tanishq in India? What is the international, store count expected to look like? And will you change it depending on how the consumer preference has changed over the last 1 year?
I think Omni is the way to go, where you continue to focus on both the channels. So we have 16 international jewelry stores at this point of time. I believe in next 12 months, we should be adding at least 12 more internationally. In India, we added about 50 stores in Tanishq this year, 46 or 48 stores. I think the same trajectory. Even expanding the existing store, which doesn't get into the count numbers, but the retail is square feet, if you see, we added almost 20% in FY24. So, and Carrot Lane added 50 stores this year. FY24, I think they would again add 40-45 stores in FY25. So that trajectory is not slowing down anyway, more or less maintaining the same momentum. And of course, focusing more on more Omni and how do we kind of attract more, convert the web traffic, which we have very, very high web traffic in Tanishq and Carrot Lane, get more and more conversion. But jewelry would remain a category where large conversion would happen in physical retail space.
Okay, all right. Mr. Sonthalia, final question before we let you go. The studded ratio, it's at around 33%. Where is that headed for on an average for this year?
I would expect it to remain there, Nigel. We don't expect, or we don't have anything to feel confident about increasing that. So gold is doing pretty well, and gold as an investment category is still very, very strong in Indian consumer mindset.
Okay, all right, Mr. Sonthalia, thanks a lot for joining in and filling us in with all of those details. Wishing you all the best for the coming year. It's a competitive environment, but you believe that you have enough in your kitty.